Hi, welcome back to Cheryll Trades LEAPS. Today I'm sharing my complete LEAPS wealth framework, the 10 rules I use to build long-term wealth with LEAPS while protecting both my capital and my peace of mind. Let's get started. Most people use LEAPS the wrong way. They discover that a LEAPS contract costs much less than buying 100 shares, and they immediately start thinking about leverage. Instead of controlling 100 shares, they want to control 300 shares, 500 shares, maybe even 1,000 shares. Then the stock drops 20%, and suddenly they're down 50%, 60%, sometimes even more. The problem isn't LEAPS. The problem is how they're using them. After years of trading LEAPS, I've learned that the biggest winners don't treat LEAPS like lottery tickets. They treat them like a business. Rule number 1. Buy great companies first, LEAPS second. Most traders ask, what LEAPS should I buy? That's the wrong question. The better question is, would I happily own this company for the next 3 to 5 years? Because if the company isn't worth owning, the option won't save you. The biggest winners in my portfolio usually share 3 characteristics: strong earnings growth, strong competitive advantages, and powerful long-term tailwinds. Think AI infrastructure, cloud computing, digital platforms, companies benefiting from trends likely to continue for years. The company matters more than the option, always. Rule number 2, buy time. One of the greatest advantages LEAPS give us is time. Time allows earnings to grow. Time allows institutions to accumulate shares. Time allows temporary setbacks to disappear. That's why I prefer expirations 18 to 30 months away. Short-term traders must be right quickly. LEAPS investors only need to be right eventually. That's a huge difference. When you buy time, you're giving your thesis room to work. Rule number 3, never go all in. This may be the most important rule in the entire framework. Let's say you have $100,000. Many traders would use all $100,000 on LEAPS. I would not. Instead, I might allocate 30% to LEAPS, 30% to shares, and keep 40% in cash or short-term treasury funds. Why? Because cash creates opportunity. When the market panics, cash becomes your competitive advantage. When everyone else is forced to sell, you can buy. Cash isn't doing nothing. Cash is ammunition. Rule number 4, buy dips, not breakouts. Most traders chase excitement. I prefer patience. I want to buy when fear creates opportunity. My favorite entries usually occur near the 20-day moving average, near the 50-day moving average, or during temporary market panics. The best opportunities often arrive when headlines are scary, not when everyone is celebrating. Remember, we don't get paid for buying first. We get paid for buying well. Rule number 5, trade the reaction, not the prediction. One of the biggest mistakes traders make is trying to predict major events: CPI, Federal Reserve meetings, earnings reports. Nobody consistently predicts these events. Instead, I wait for the reaction. Let the market show its hand first. Then I decide. The market is a voting machine in the short term. Pay attention to how it votes. My signature philosophy is, don't trade the news, trade the reaction. Rule number 6, quality matters more than implied volatility. A lot of traders obsess over implied volatility, and yes, it matters, but not as much as quality. I would rather own a fantastic company with slightly elevated implied volatility than a weak company with cheap options. The order of importance is simple: company quality, earnings growth, long-term story, technical setup, then implied volatility. The stock drives the trade, not the option chain. Rule number 7, scale into positions. I almost never buy a full position all at once. Instead, I build. Let's say my target is 4 contracts. I might buy one today, one on a pullback, one after confirmation, one after earnings. Scaling reduces emotional pressure and helps avoid terrible timing. Nobody consistently buys the exact bottom. You don't need to. Rule number 8. Trim before earnings. This rule has saved me countless times. If a leap has already produced a strong gain, I often reduce exposure before earnings. Not because I'm bearish, because I'm managing risk. Earnings are binary events. Great companies sometimes sell off after excellent earnings. That's just reality. If you're sitting on a nice gain, consider paying yourself. You can always buy back later. Rule number 9. Shares first, leaps second for high-risk names. For highly volatile stocks, I often prefer owning more shares than leaps. Why? Because shares don't expire, shares don't suffer from time decay, and shares are easier to hold through volatility. While leaps are powerful leverage, capital efficient, and time sensitive. Leaps are powerful, but shares provide staying power. Sometimes the best portfolio combines both. Rule number 10. Protect your emotional capital. Most traders only focus on financial capital, but emotional capital matters just as much. A good position should let you sleep. A good position shouldn't force you to check prices every 10 minutes. If you're constantly stressed, your position is probably too large. Reduce the size. Investing should feel boring most of the time. That's usually a sign you're doing it right. My LEAPS playbook. Here's how I put everything together. I buy great companies. I buy lots of time. I scale into positions. I keep cash available. I trim winners, and I stay patient. That's it. No magic indicators. No secret formulas. No lottery ticket trades. Just discipline, consistency, and risk management. If there's one lesson I want you to remember, it's this. The goal isn't to maximize leverage. The goal is to maximize opportunity. Use leaps to reduce capital at risk, not to increase risk. Buy great companies, buy time, stay patient, and let compounding do the heavy lifting. If you enjoyed this video, hit the like button, subscribe to Cheryll Trades Leaps, and let me know in the comments, what's your favorite leaps position right now? I don't trade the news, I trade the reaction. Thanks for watching, and I'll see you in the next video.